Welcome to our fourth quarter market outlook and market update. So guys, Freddie and Adam, can you give us a recap of the last quarter and go over what's driving markets today?
Yeah, I'll kind of start off and let Freddie kind of fill in as well. But obviously, the real point is that 2024 was a fantastic year for equity markets. The S&P up, over 20%. This was the second year in a row it was up 20%. So, that obviously is a great investment landscape to be in if you're involved. Fixed income was relatively flat. I think the ag was up just about 1% for the year, with a lot of fluctuations in interest rates kind of driving that through the year. But as a whole, I would say it was a good year, like I said, in particular in equity markets and the U.S. markets for the most part.
Yeah, I agree with that. So let's see, let's go to our next question. How do you think the Federal Reserve's monetary policy will evolve over the course of 2025? And is the Fed still aiming for its 2% inflation target?
Yeah, so I mean, similarly, the Fed has been a large focus for the markets over the last couple of years, and trying to figure out whether they're going to make any interest rate cuts, and then how aggressively they're going to cut rates. Looking back last year, it seemed like kind of a long year in that regard. But if we think about this time last year, the Fed was, the expectation, at least that the markets had, was that the Fed was going to cut 7 or 8 times in 2024. Obviously, we didn't get anywhere near that. We got three by the end of the year, and really all those cuts came at the end of the year. So the market obviously got it wrong, and so I think this year is going to be more on kind of a wait and see. And when you look at right now, the Fed is kind of in a difficult place because inflation has remained relatively sticky, and the jobs number has been getting, I guess, a little weaker until last week. We saw it actually strengthen again. But overall, unemployment is historically low, at roughly 4%. And then with inflation, that if they really do make 2% their target, which in some regards is an arbitrary number, I think that's going to take quite a while to hit that. So to go from 3 to 2, I think is going to be obviously much more difficult than going from the highs of inflation to where we are today. But I think inflation where it's at right now is quite manageable when you have such a strong U.S. economy, and I think that in itself is what's going to make it difficult for the Fed to cut rates any further. Right now there just isn't enough reason for them to ease policy at all. So I think you're probably going to see them kind of have that wait and see, probably. And I think, Freddie, tell me if I'm wrong, but I think markets are still pricing in one cut in 2025, and so obviously
and one cut in 2026 as well. So.
Yeah.
Wow.
So markets have obviously pulled back their expectations that the Fed's going to move aggressively. The caveat to that is obviously if we saw unemployment tick up, or we saw GDP growth start to fall off, then that would change the entire kind of narrative here. But for now, with the information we have and the strength that we're seeing in the economy, we just don't see the Fed cutting much here in 2025.
Okay. How are trends in consumer spending and savings rates impacting capital markets?
Yeah, so we're seeing retail sales growth consistently beat expectations for the last couple of months now. For November, retail sales showed a 40 bp increase over month. And the strength of this consumer has been pretty unexpected, as Adam alluded to. And that's been really a big driver of the S&P, the 25% gain we saw in 2024. The expectation was always that we would end up in a recession, and that likelihood kept dropping, so stocks just kept going up. But one of the metrics that we're going to be watching closely is the U.S. personal savings rate as a percentage of disposable income. That number is currently 4.3%, and this has fallen every month for the last 12 months. If you look back at January of 2024, that number was 5.5%. So all that to say, if something does happen, this could be a contributing factor, as consumers may not be as prepared with these lower saving rates. But in general, we see the consumer remaining strong based on all macroeconomic data that's been coming out. So,
okay. So, what are your expectations for the S&P 500's performance in 2025?
Yeah, so the driver of equity markets is going to continue to be these mega caps that continue to be a disproportionate weight of the index. The top 10 companies in the S&P make up 40% of the index. We now have 10 different trillion-dollar companies in the S&P. The Mag 7 alone contributed to 30% of total earnings. So that's going to be one of the main catalysts for continued upside. Over the last 2 years, we saw the Mag 7 earnings growth of 11%, while the rest of the index grew 3%. So these companies need to continue growing in the double digits as the S&P is forward-looking, and we're really focused on rates of change. So the expectation now is that these companies are going to hit their estimates, meaning the S&P is really priced to perfection. So any misses among the Mag 7, the stocks could face downside pressure, and just given how much weight they make up, it could be significant. So
Okay. That makes sense. Let's see. And how are the projections for GDP growth between the US, other developed economies, and emerging markets impacting your strategies?
Yeah, so I mean, look, investing in the U.S. has been the way to go for the last at least decade, and that's coming on the heels of obviously the U.S. economy has outperformed all other economies globally. That's even when you're looking at some of the emerging markets, you've seen even China, which is kind of one of those higher growth kind of large countries, has struggled to maintain the level of expectations you would have out of a pseudo emerging market. So I think we're going to see that trend continue. You're still seeing a lot of economic weakness. Obviously, there's quite a bit of weakness out of Canada. Europe has got a ton of issues to overcome, and then even Japan, which was seeming to kind of come out of its deflationary period, is still struggling to find any growth. And then obviously we talk about China, and they did add stimulus this last year, and that did give those stocks a good amount of upside, but that stalled out very quickly after Trump was elected on the fears of what some tariffs and that sort of thing could have on their export economy. So I think when you're looking forward, one of the big indicators that we're looking at is the strength of the dollar. So the U.S. dollar has remained very strong through this cycle and still is, and as long as that happens, as long as the U.S. dollar is relatively strong, we think it's going to be difficult to see capital flows into other countries other than the U.S. Because obviously, if you're in another country, you're going to want to go where the currency is stronger and that economy is stronger. So it's kind of this circular event that happens. And so until we see the U.S. dollar weaken, I think it's going to be difficult to invest outside of the U.S. And so you'll see that translate into our strategies where we're definitely underweight relative to global indexes.
Okay. Now, what sectors are overweight or underweight in your portfolios?
So we're going to continue staying overweight communication services for the first quarter of 2025. Meta and Alphabet make up about 40% of this ETF. And we believe that among the big tech, these companies are trading at reasonable valuations. Alphabet's at 23 times forward earnings and Meta's at 27 times forward earnings. Spending on advertising has remained very strong, which is the majority of these companies' revenue. There's been a lot of speculation also on the regulatory actions that could limit the ad targeting advantage of both Meta and Alphabet. And that's keeping a limit on the ceiling of these stock prices. And we think that's a little bit overplayed. So we like the upside of this sector still. Okay. On the other side, we're going to go underweight healthcare in our portfolios. Markets have been taking in the election results, and there's been a few key political appointments that we feel are going to impact this sector. It seems that there's going to be a lot of regulatory uncertainty when it comes to drug approvals, specifically within the biotech sector. So we are selling out of that fund, just given that we believe the performance will be more muted for biotechs moving forward.
Okay. Now, how do you see markets adapting in the new year, and how are you positioning portfolios for this?
Yeah, so markets are really taking in the possibility that we could really stay higher for longer when it comes to rates. We mentioned the rate cuts. We're expecting maybe one cut in 2025, and we won't have a second cut until the end of 2026. 2026 or probability wise. And I mentioned investors have been expecting a recession for over a year, and with the strength of the consumer, it just hasn't happened. Having said that, though, there's still no doubt to us that the S&P is still very richly valued at 27 times earnings. And you're also not getting the diversification benefits that we were once getting in the index. There's an incredible allocation to just a few stocks and just one sector, basically in general. So we're going to continue to build in that diversification where we can through ETFs with lower downside capture, such as dividend, low volatility, equal weight ETFs. But we also want to take advantage of the growth we're seeing by investing in companies that still trade at reasonable valuations, despite the run-up we've had over the last 2 years. In that scenario, if the market does continue to rally, we're still going to participate in the upside as well. And so let's just hope for another good year.
Yeah, fingers crossed. And I'm just going to throw in one more question. What do you think about small caps this year?
I'll give my opinion, and Freddie, you can chime in. I think it's another one where it really depends on the regulatory environment. So that would be a positive for small caps. On the flip side, though, I think you've got to look at, what banks are doing and the lending that's happening there. You have seen banks kind of tighten their standards. And so those two kind of offset one another. And if you see banks, not lending at the rate that they typically would, that does make it difficult for small cap companies to grow. And so I think right now, what I'm seeing, I think they're still going to underperform whatever's happening with the S&P 500. I think you're going to have to see a pretty dramatic change in momentum earnings before you'll see that kind of shift away from large cap into small cap.
No, I agree with that. And you're also taking a much higher risk owning small caps. The standard deviation is 5 to 10% higher, depending on the time horizon you're looking at. So we feel for the risk reward, it's better just to stay allocated more towards large cap.
Okay, well, thank you so much for the update, and look forward to 2025.
Yeah, thank you.
Okay, take care, you guys.